Should you buy cheap or expensive investment property? I see people make this mistake all the time. They buy a really expensive investment property thinking that it's going to be a higher quality only for it to fall in value. What you should be buying right now in the current market, if that's what you're interested in, carry on watching. My name's PK and I help people build passive income using the Property Investment Accelerator, using data without needing a $15,000 buyer's agent every single time. In this channel, we talk about the local economy, we talk about property investment, and we talk about financial happiness, not to be confused with real happiness. Okay, so smash the subscribe button, give it a thumbs up, give it a like. I'd super appreciate it. Let's go. So this first chart, what you're seeing here, courtesy of Jeremy Shepherd, is the annual change in property values combined capital cities. Okay, and what this is showing, the median, which is the black line, going back 20 years, it shows the ups and downs of a property price growth. Okay, so this is an absolute property price, this is property price growth. Okay, so you can see property rises, it kind of falls a little bit in terms of a growth, rises, then has a period of negative growth, ever so slightly, you know, in the GFC about 8% negative growth, goes up, like a cycle. And then you have the top 10th percentile of property. So this is the most expensive property. Let's just say for argument purposes, over $1 million, this light gray bar. So you can see that the light gray bar versus the median, it falls more, okay? It kind of marries the median on the way up and then it falls more, marries the median, falls more. So you can see that the median value of property prices across Australia have only really fallen or gone negative, you know, once, twice, 3 times, 4 times just in the last 20 years. And even then it's been, you know, -2%, -5%, -8%. But the most expensive properties, the top 10th percentile of properties, they have fallen 4 times as well, but by a much more exaggerated amount. So in the GFC, where the average property price, this is just the average, right? Medians fell by about 7 or 8%. You know, the most expensive properties fell by about 15%. And here's the really interesting thing. The cheapest properties, okay, so the cheapest properties, the properties that are, you know, the least expensive, you can see in this blue line, the least expensive properties, so the opposite of the most expensive properties, this blue line, you can see here that when there is an upturn, they've significantly outperformed the median, okay? And when there's a downturn, it hasn't actually gone into negative growth territory. It's still been growing, okay? Markets within markets. When the property prices went down here for the cheaper properties, they didn't go down. They still grew by 10%. They grew on the way up, and on the way down, they still grew. They grew on the way down, on the way up, on the way down. This is the only time the blue line has actually gone negative, and even still not as much negative as the median and expensive properties on the way up. So you can see by just that chart that in the point of the cycle that we are right now, where national property prices are coming down, led by Sydney and Melbourne, the most expensive properties across the country, but especially Sydney and Melbourne, are the ones that you should be avoiding. Okay, so if you have $1 million of borrowing capacity, your mortgage broker's told you that, maybe it's not a good idea to go out and buy $1 million investment property. Maybe you want to cut that up into 2 or maybe 3 investment properties. Second thing that I want to talk about is, okay, how do we execute this strategy of buying cheaper versus more expensive investment properties? Okay, not only will cheap properties not suffer as much, in fact, many of them will continue to grow really quickly, and they will give us more yield, higher positive cash flow, which is what we want. But where can we find these? You know, where are the areas that are less susceptible to falls? This is a fantastic piece of data by Matusik. Go check him out. But effectively what he's done is said that if house prices could only be 6 times that of average incomes, how much will house prices correct, go down, or fall or go up, continue to go up across different cities across Australia? So there, this column, he said city by city, the March median value, and this he's adjusted sustainable price point. So if every capital city, the house price could only be 6 times the average salary or household income, where would house prices land? And you can see that the change is what we're really interested in. In Sydney, they would have to correct by 21%. They would have to drop by $340,000 on average to be only 6 times that of income. In Melbourne, they would drop by 18%. Brisbane, they would actually go up. So you can see Brisbane on this measure is relatively affordable. They would go up 5%. Adelaide, they would go up 7%. Perth, they would go up 33%. You can see how much value there is in Perth. Hobart, they would go down 8%. Darwin, up 14%. Canberra, down 11%. And Australia as a whole, down 11% if house prices were only allowed to be 6 times that of income. So the first point here is that, yes, Australia should go down by 11%. I fully expect that to happen as well. But markets within markets, there can be individual cities, individual towns in Australia that can have double-digit growth, even whilst the media is painting this doom and gloom picture of house prices falling. And this doesn't include regional areas. I might do my own analysis on regional areas, and the analysis looks a bit like Perth. It looks a bit like Darwin, really favorable for so many regions across most states and territories, led by Queensland, New South Wales, Victoria as well. Regional centers, even if incomes are house prices only 6 times that of income, regionals have so much more, so much further gains to be achieved. And it's these regional areas that have the lowest vacancy rates, which is amazing as well. And the second point I wanted to make on this is that these areas that are the most affordable, according to this measure, that have the most potential for upside, are the areas that are the cheapest, right? So Brisbane, Adelaide, Perth are much cheaper than Sydney, Melbourne, Canberra, etc. So the analysis that we just did showing how cheap properties, let's say under $500,000, they don't actually really fall even in a recession, even in a downturn, right? Those are the ones we want to buy. That just coincidentally happens to be the areas where there's the most opportunity. So I'm not saying, right here to go buy in Darwin. There's so much more that goes to it. Like the media tells you a single data point and it sells you a click. They want you to click. That's called clickbait. The reality is that we need to paint multi-dimensional data stories to understand which suburb we should buy in. Even in a place like Canberra, there will be suburbs that continue to go up and there will be suburbs that fall by 20%. Same with Brisbane. There are suburbs falling right now in Brisbane, even despite this, figure of 5% upside. We need to paint multi-dimensional data stories at the suburb level, at the city level, at the state level, at the Australia level to really understand where we should invest. And that is what I'm hoping and I'm trying to bring to you guys. Ignore the media, focus on the data. If you want to level up your knowledge in this, then I'll leave links below to my Facebook group, almost 20,000 people in there now, my podcast. You can really get, invest in yourself. No one else is going to invest in yourself. You have to do it in the 6 inches between your 2 ears. That is the most important real estate. Smash the subscribe button, smash the thumbs up button. I hope you got a ton of value, and remember, it's not about when you buy, it's where you buy and what you buy that counts. Catch you later.